Today, I'm going to discuss a crucial piece of retirement advice that many financial advisors ignore completely for a variety of reasons. Coming up on almost 2 decades of being a financial advisor, I've noticed time and time again that most people are missing this key information that can change their entire retirement. If you're new to the channel, my name's Justin. I own a financial planning firm in Lewisburg, Pennsylvania, where we work with clients from all across the country, helping them make smart financial decisions. And that's why I'm making today's video. I want to reveal what this critical piece of advice is that could transform your retirement planning and help you evaluate whether your current advisor is doing all that they can to help you as much as they can, or if you're doing all you can to help your own situation. So let's dig right into it. All right, so there is a fundamental aspect of retirement planning that many advisors either overlook or they intentionally avoid discussing this for reasons I'll get into in a second. But this isn't just another financial tip or hook to keep you watching. This is a core planning principle. It's super important and it affects virtually every aspect of your retirement. And here's why this specific advice dramatically gets overlooked. So for one, it contradicts what many advisors are incentivized to recommend. And second, industry structures and compensation in the industry just often prevent advisors from emphasizing it or talking about it. And then the third reason is that expertise and education on this topic just isn't that widespread amongst many financial advisors. And this isn't just theoretical. I have personally seen this firsthand and working with clients for years, and how this approach can actually have such a huge effect on retirement outcomes for clients of all different wealth levels. So many investors don't realize that one of the biggest factors to their retirement isn't just market volatility, it's avoidable taxes. While most people focus just on portfolio growth, these overlooked strategies directly impact how much of your money that you actually get to keep, which is what's very important. And clients who use these approaches that I'm going to talk about, they pay way less in taxes year after year without having to change their investment goals. They create more stable, tax-efficient income throughout their retirement. They take advantage of opportunities during low income years that many other people might overlook. And they reduce unpleasant tax surprises like big capital gains distributions or unexpected RMDs, pushing them into higher tax brackets. Probably the biggest benefit of this approach is that it increases your long-term returns by reducing overall tax drag on your investment portfolio. Very critical. Incorporating these things into the whole overall planning philosophy changes the outcome dramatically, not just in theory, but in real actual dollars, and yet it's still largely absent from most financial advisory models. Now, what I'm about to share might sound initially foreign to you if you've been working with a traditional advisor for years, especially one maybe from a big box firm, but understanding these principles and what I call proactive strategic tax planning will completely transform how you view your overall retirement, and this will help you immediately evaluate whether your advisor is actually doing everything they can to help you or if they have the requisite knowledge and skills to help you most effectively. And now, if at any point you feel there's some pieces that your advisor might be missing, or if you're doing things on your own and you feel that there's things you might be missing, just click the link in the description, fill out the quick questionnaire. It's totally free. Afterward, I will send you back a personalized video reviewing your plan and highlighting any gaps and giving you some recommendations to improve on it. So now let me break down the 3 components that make up strategic tax planning. And this is way different from tax preparation, which is what most people are used to, right? You get all your documents in, your 1099s, all that stuff. You give it to your CPA. They do your taxes and they tell you, oh, you owe this much or you get this much refund. And then you don't really talk to them until the next year. And in my experience working with clients, that is the overwhelmingly most common scenario. There's very little tax planning done because most CPAs just don't have time to do that or the bandwidth. They're trying to crank through as many returns as possible. So a lot of this stuff just does not get talked about from the CPA or tax preparer angle. So the first method I'll talk about is what we call tax loss harvesting. And tax loss harvesting just refers to selling investments at a loss in non-retirement accounts to offset capital gains elsewhere, effectively reducing your annual tax bill and preserving your wealth if done correctly. According to a study done at MIT called An Empirical Evaluation of Tax Loss Harvesting Alpha, they found that given long and short-term capital gains rate of about 15%, 35%, they found that a tax loss harvesting strategy yields a tax alpha of about 1.1% per year from the period of 1926 to 2018. Even if constrained by wash sale rules, it still provided a benefit of close to 1% per year. So doing this properly, incorporating tax loss harvesting correctly, and even what we call tax gains harvesting, which I don't have time to get into. I could make a whole separate video on these topics, and I probably will. But incorporating these correctly can save significant money, reduce tax drag over time, so that benefit can be quite substantial. The second method in strategic tax planning is what we call asset location. So this just means strategically placing investments in specific accounts, like having certain investments inside of an IRA versus inside of a non-retirement account. For example, you might want to place taxable bonds or bond funds that spit out interest tax at ordinary income tax rates. Those should be inside tax deferred accounts where you won't have those tax consequences every year. Looking at an example of this from Vanguard's website, they have an example of a $1 million portfolio split equally between stocks and bonds across 3 types of accounts. And in most places you'll see, or most automatic model portfolio allocations, you'll see every account is set up the same. Whether it's in traditional IRA, Roth, non-retirement, every account is exactly the same. But if you actually do this differently and add the taxable investments, put those inside the traditional IRA, and then put the tax efficient investments, for example, like broad-based market ETFs inside the taxable account, things with low paying dividends or only qualified dividends as we call them, that can actually lead to having a 0.05 or 0.30% per year difference and boost in the returns. And then the third method I'll talk about is Roth conversions, which I've spent considerable time talking about in other videos. But converting traditional IRA funds to Roth IRA in lower tax years, or perhaps if you're in a 12% bracket and you can pay lower taxes now at 12%, you can reduce some of those future tax burdens and start building up tax-free withdrawals later. If done correctly, based on your circumstances, depending on how much money you have, this could save you tens of thousands or more over the course of your retirement. So it's pretty significant. And so collectively, implementing all these strategies together can potentially improve your after-tax returns by approximately 1% to 2% a year or more. Just looking at Vanguard's own study that they've done since, I think, about 2001, they've replicated this every single year. They show that just asset location strategies plus withdrawal sourcing strategies, meaning where are you taking your investment withdrawals from, Roth, traditional, doing Roth conversions, and then rebalancing, these can add anywhere from 1% to 2% or more a year in total value. So doing these strategies effectively and correctly can have a significant impact on your long-term wealth. And I'm just going to say it might ruffle some feathers, I might get flamed in the comments a little bit, but if your advisor is not implementing these strategies and not doing these, you need to get a new advisor. You are likely way overpaying in fees, especially if you have a portfolio going on 500,000 up to $1 million or more. If this isn't part of the process and you're paying fees just for an investment portfolio, you're not getting good value for the money that you're paying. And if you're a do-it-yourselfer and you didn't know about these strategies or you're not implementing them effectively, then you should consider hiring a knowledgeable advisor who does know how to do these things. I know everybody wants to avoid fees, and there's a lot of literature and stuff out there saying paying advisor, bad, doing it yourself, always good. But you could be shooting yourself in the foot by not implementing these things correctly. After all, you just don't know what you don't know. And I would say your advisor should be looking at your tax returns at least at a minimum. If they're not asking you for your tax return, or you hear, oh, sorry, we don't give tax advice, then you definitely need to have a new advisor. And now, am I just out trying to bash other advisors? Not at all. I find most advisors, they don't emphasize this, and they don't do this because, number one, a lot of times the compensation structure discourages it. So some advisors still just get paid on commissions or just only on gathering assets. So they're incentivized just to, focus on the investment side because that's what they're trained on. They're not necessarily have any incentive to help you reduce taxes. And the second reason is because it's not scalable. Strategic tax planning requires a lot of personalized, ongoing work. It doesn't fit in well with a lot of cookie cutter models that many large firms use to try to grow and scale and gather as many clients as possible. They just don't have the time or want to spend the time and manpower to try to do that. And probably the most important reason is that implementing these strategies, it takes real expertise. So understanding tax inefficient investing, Roth strategies, tax loss and gain harvesting, it requires a good bit of deeper knowledge and constant updating and education on tax code changes, what the research shows and all that. And there's a big gap in financial advisor knowledge in the industry. There's people on one end who are very knowledgeable, have a lot of advanced knowledge on finance and taxes, and then there's some at the other end where they just got licensed, but they can both slap financial advisor or financial planner on a business card. But in reality, there's a very big gap there. And it's just not a focus in a lot of advisor training. Most certifications and training programs emphasize sales, number one, portfolio construction, risk tolerance so the firms don't get sued, not tax optimization. In fact, if you're coming from a big box firm, or maybe even if you're a do-it-yourselfer, you might have heard the phrase many times that, oh, I'm sorry, we don't touch tax advice. In the beginning of my career, I came from a large firm, and that's exactly what they told us to tell clients is that, I'm sorry, Mr. and Mrs. Client, we can't give tax advice. You have to talk to your CPA. And I think the last reason it's not talked about is clients just don't know enough to ask for it, because the average investor doesn't understand these strategies because some of them are a little bit technical and a bit complex. So there's very little pressure on many advisors to provide them unless they actually specialize in that area. But after going through this, I think you can see now why strategic tax planning is so critical. So those who don't use this approach are leaving thousands on the table in avoidable taxes, missing windows of opportunity to shift income more strategically, and they're experiencing unnecessary tax drag from maybe 1% to 2% a year that erodes long-term compounding. And so to help you avoid some of this, I'm going to share 4 key ways that you can start to implement or look at your investments and evaluate them to make sure that you have some strategic tax planning in there. So number 1, asset location. So start by looking at where your investments are held. And if you have big non-retirement accounts, I'm really talking to you here. This is really critical. So place the tax inefficient assets like taxable bonds, bond mutual funds, things like that. You want to use those inside your traditional IRA where you're not getting those taxable consequences every year. And then you want to hold tax efficient assets like, again, broad-based market ETFs inside of taxable accounts. So this will help reduce that annual tax drag and increase your after-tax returns. So the second one is called tax loss harvesting. So you want to scan your non-retirement accounts for positions that might have losses. If you're able to, you could sell and what we call harvest the loss, and you can hold that loss indefinitely to offset capital gains into the future. Now, I do want to give a word of caution. There are some steps to doing tax loss harvesting. There's some rules you have to be aware of. So don't take this as advice to just jump in and start doing it unless you really know what you're doing or working with somebody who's familiar with the process. The third is in Roth conversion. So if you're in a low income year or early retirement before Social Security and RMDs kick in, consider converting part of your traditional IRA to a Roth IRA. This can lock in lower tax rates today and can set you up for tax-free withdrawals later. Same disclaimer as above. Make sure you know exactly what you're doing or you're working with somebody who knows exactly how this works. There's a lot of complex factors that go into Roth conversions, and you want to make sure you're accounting for those to do it correctly. And the last way is through having tax-efficient investments. And this goes back to looking at your non-retirement accounts as well. So where possible, you want to try to use ETFs instead of mutual funds because generally ETFs are a lot more tax efficient due to their structure, which will limit those capital gains distributions that can create those tax surprises. So try to use ETFs where possible, or try to use as tax efficient investments as you can in those non-retirement accounts. So if you're wondering if any of this applies to you, or if your advisor is doing any of this stuff, or if you know for sure that they're not doing any of this stuff, and you want to get a second opinion, feel free to click the link in the description below. Fill out a quick questionnaire. I will send you back a personalized video giving you my thoughts on your situation and some steps that you could possibly improve that. If I can help, let me know. I'm glad to do it. Thank you again for watching. I really appreciate it, and I will see you in the next one.